Shares in Miton Group surged to the highest level since 2008 after better than expected earnings. But with regulations from MiFID II, uncertainty around Brexit and an increasing taste for passive investing, can the rally continue? I'm pleased to say I'm joined by the company's CEO, David Barron. David, thanks so much for joining us.
Hi.
So obviously in your latest results, we saw profit before tax up 45.5% year on year, net revenue up 15%, fantastic results.
Yeah.
You must be very pleased. What's driving the growth?
Yeah, we are pleased. It's a strong set of results. I mean, what's really driven the results is, first of all, good underlying investment performance, with 87% of our funds are first or second quartile against their competitor set. So that's, you know, for a business like ours, strong differentiated investment performance is really at the heart of what we do. That in turn has driven good new flow, so clients putting more money into our funds. So our average AUM were up about 21% last year. That in turn drives good revenues. We've kept the costs under control, which then feeds through to good earnings and the ability to pay a dividend that was up 40%.
So I want to ask you about the dividend in a second, but
Yeah.
What's the appetite been like for investment into your UK funds? Because it's no secret that there's been concerns about the UK economy, Brexit, and indeed the growth outlook.
Yeah.
Has there been any talk of issues around the level of investment?
Yeah, it's a really interesting one, that, because we do track that quite carefully. If you look at the wider investment association sector for UK funds, I believe there were outflows all 4 quarters last year, and indeed that has continued into the first quarter of this year. But what's interesting about Miton, and I think this is because our funds are doing something different, is that we saw inflows, net inflows, into our funds invested in the UK in those 4 quarters. So I think, you know, that really goes to the heart of what we're trying to do, which is just to be something a bit more different, and to our strapline, which is genuinely active fund management.
And so do you see those net inflows increasing, at least in the pace that they have been over the last sort of 14 months, say?
So we've started the year well. We updated the market in March that our AUM were just around 4.1 billion. We had 190 million net inflows into our funds in the first 2 quarters, and I think we're competing well in the industry. I think what's interesting is we're seeing inflows both into our UK funds, but increasingly into some of the other single strategy funds. So Europe, the US are doing well, and our multi-asset business. So, you know, it's very difficult to predict the trajectory, but the year has started strongly for us.
And I noticed a buzzword in your literature, this diversification plan.
Yeah.
Where are you looking to diversify towards? Where's the future growth coming from?
Yeah. So since you know, Miton in its current guise really started in 2011, the new management team came in and Gervais Williams joined us to set up the single strategy funds alongside our historic multi-asset focus. We've launched a number of single strategy funds, obviously multi-cap income, diverse, and the UK Smaller Companies Fund were the first of those. And multi-cap income is now a £1 billion fund. So we see the growth now being carried forward by some of the other single strategy funds, the European fund, the US fund. We launched an infrastructure fund last year, the UK Value Fund, and the multi-asset fund multi-asset range, I beg your pardon, always sees good inflow. So those are capable of good growth, and we have the capacity to launch other strategies.
So does that mean you're less confident now in the UK small cap sector?
No, I think we are confident about the UK small cap sector. I think it's a very good diversifier. It's something of a real strength in the UK that we have both the LSE and the AIM market, and I think we've still got we've still got more room for growth in that area. But I think it's other things coming in alongside, as well as the UK small cap side.
Let's talk about MiFID II. How's the new European regulation impacting you?
So MiFID II has been a huge amount of work for all asset management firms. There's no getting away from that.
Absolutely.
I mean, it's taken up a lot of management time. I think we have a number of advantages. We're a pretty simple business. We have 13 unit trusts and 3 investment trusts, and by and large we sell UK funds to UK investors. So from a regulatory perspective, we're quite straightforward. The principal area that's impacted us is obviously around the whole research side, where we've taken the decision to agree a research charge with clients, so-called RPA route, which is one of the routes that the FCA has allowed. And that's all in place now and functioning. Keep monitoring client reaction to that. But that's the way we've gone. Other areas, trade reporting is a lot of work. But actually, we feel it's something we've got over the worst of, got over the hump, if you like, on that one.
So there's been this increasing trend towards passive investing, and part of that, of course, is because of the lower fees. Is that putting increasing pressure on your fund managers to deliver? And does that weigh on their ability to take calculated risks, bolder calls?
Yeah, I mean, the whole rise of passive, I don't think is going to go into reverse. And particularly in the UK, we've seen passive grow to the point now where I think it's about 13% of AUM and 25% of net flows go into passive. So it's a big part of the industry. I think what it does do is it forces active fund managers to really differentiate their products or their offerings. So if you can get passive very cheaply, very easily, if you're an active fund, you've got to be, in our language, genuinely active and differentiated to justify that active fee.
And is that why we've seen net management fees in terms of the margins come down slightly?
So we've seen some fee pressure, and I think that will continue to be an industry feature. I think we feel with our active funds we're good value for money for the performance and the overall cost. So we feel that's good. But I think the fact is that lots of our customers are themselves under scrutiny for their charges. We've got to be sensible about that, and they want to have a sensible conversation with us about the fees. But we think where we are is very defensible for the performance and the overall cost, not just the AMC of our funds.
Now, we've seen some consolidation in your industry, most notably between Standard Life and Aberdeen, the £11 billion merger that completed last summer.
Yeah.
Would inorganic growth be a route that you'd be willing to explore at all, or do you want to continue to go it alone?
So yeah, we have done some acquisitions in the past. We bought the Darwin business to bring David Jane and his team in to run the multi-asset funds. We bought the Sigma Income business a few years ago. So we don't need to do acquisitions, but I think there will be more opportunities for those. There will be people who find life is a bit harder, fund managers or teams who want to come to somewhere perhaps a bit more entrepreneurial. So yeah, we won't rule it out, but we don't need to do it. We've got the financial strength to do it. We've got about 19 million in cash on the balance sheet. So we can do it, and we will look at sensible things, but we don't need to do it.
Now, I wanted to get your view on the markets, because there's a lot of concern from global investors about the outlook, particularly for the FTSE.
Yeah.
It seems as though more broadly in global markets, complacency last year has been replaced by volatility this year. Where do you see the FTSE going from here?
So the FTSE, the FTSE is a very internationalised index, very internationalised benchmark. It feels to me like volatility and these shocks are here to stay. We're going to have to get used to that. There's a great deal of global uncertainty around on the geopolitical side and on how central banks react to the end of, or how markets react to the end of QE. So I think caution is the watchword. Actually, I think we need to be quite cautious about markets at these levels, and investors should look to be well diversified and look for assets that don't correlate that well with the FTSE. That would be my view at the moment.
Okay, David, thank you so much.
It's been a pleasure. Thank
you.
That
was David Barron, CEO of Miton Group, joining us here on IGTV. I'm Victoria Scholar. Thanks so much for watching, and we'll see you very soon.
Subscribe to IG for educational content, company insight, financial analysis and expert commentary.